I think you know that the stock market is pulled by many forces. It may be internal, external, sometimes even commodities, other rupee and dollar movement. Everything has impact on the stock market. First January 21, the SENSEX was around 47,000 something. Today it is 57,000. So 10,000 points journey took place just in 1 year. When we had last time the same program, I think the speakers insisted that definitely there is a door for India, there is a door for development of India. How many of you believed that and invested, we don't know. So if you invested, definitely the return is reasonable and good comparing to fixed deposit interest or whatever interest you are getting in normal way of investment. So today, Hindustan Chamber of Commerce really very proud in association with STOA, ANMI, and Business Standard as well as Nane Vigada. We are presenting this wonderful seminar, SENSEX 2022. In fact, I am representing ANMI also, that is Association of National Exchange Members of India. I am a national director on that. That association is nothing but representing the intermediaries of capital market. We are having around 1,000 members across India. Our headquarters is in Mumbai. So we used to have international, national conferences on stock market or capital market. And there also we are having continuously international conference at Mumbai, Delhi. Because of availability of speakers, it is being held in these two places. So today, the ANMI also is very much proud to associate with Hindustan Chamber. Always our source is Business Standard. They have extended always their what is called association for the benefit of Hindustan Chamber in many ways, and this is today also they have extended their contribution for the success of this program. I think this stock market, as I said, is a very difficult game to play. Very difficult game to play. You have to be updated every second, every minute, and every hour of your life. Unless that updation happens, you cannot, take part in the stock market, or you cannot take the benefit out of stock market. Many players are there in stock market, investors there. We are having day traders like that, long-term investors there, short-term. So different types of players are there. When you have non-homogeneous players, naturally it is a tough ground for playing. It's very difficult because nothing homogeneous there. One fellow will have objective differently, another fellow will have object differently. But normally in our SENSEX, we used to rather inform you be a long-term investor. That is what normally we used to say that. Because whenever you are a long-term player, naturally the downside also is taken care. You need not worry about, for example, last a few days back, we had a heavy fall in the market. But now I think for the past 3 days it has gone up in a better way disposition. Of course, in days to come, many factors is going to decide the functioning of the market. One is this Omicron, what going to be the figure for Omicron in days to come. If it is going to be severe, then the market will feel the heat of it. If it is not going to be so severe, it is going to be just like that, a regular fever or something like that, then actually the market will set aside that and move forward very fast. There's no doubt about it. Definitely it will go back to the highest number which it touched a few months back. Otherwise, we are having a problem. Similarly, the other issue is European segment is having severe problem of this Omicron. If the international trade is going to be affected because of this, naturally India is also will be affected. So that impact will be there. So by and large, if you see that only the factors outside India is going to decide the movement of the capital market. Of course, in India, if you say per se, the companies, they are doing very well. They are giving their best in earning, in showing performance, barring some few companies. Similarly, IPOs also coming out successfully, except a few things which happened recently. Today also there is an article that 46% dip in IPO prices, whatever recent IPOs have come. So I want to tell you all of you that today we are having two eminent speakers, one from Sundaram Mutual Fund, another from Franklin Templeton Fund. I think they are having enough experience and knowledge giving you the rather next course of action for the year 2022, what will be the stock market. So with this, I welcome once again today's speakers, my colleagues in Hindustan Chamber, past presidents, for this valuable program. Thank you.
We have here in Hindustan Chamber two eminent personalities, one the president and the other the president-elect from the capital market. So as capital market participants, it's really important that we focus a lot on that, and that has been the desire of both of them. And we thought, why not we start with this program, which is a flagship program, and we would be doing a lot more programs, some of which will be online and some of which will be in the physical mode like we have here today. The idea is that when the economy comes back to growth, we would be able to educate our members and the members of the public at the right time on the right subjects and keep it going throughout the year. That is going to be what we are going to do, and this is the first step in the direction. Today we have with us two very, very eminent professionals from Chennai, one an economist and the other a fund manager. Chennai is a country, is a city which doesn't know its own worth. So that way we are a very undervalued society in our own minds. So our idea of how to value ourselves is very poor, and it's very interesting that today we have probably the best economic thinker going to talk to us, and he's from our city. So give a big hand to him. Arjun is somebody who communicates every single day on everything that he finds on the global economy. His Twitter handle is like a university. You can follow him, and you will get to know everything about what is happening in the world and his perspective on everything. He sticks his neck out. He's not like your Delhi economist. So he sticks his neck out on everything that he reads and he understands. So there's a lot of hard work that gets distilled and it's put before us every single day. As for Anand, Anand is a market veteran. I've known him for nearly 27 years, since 94. Anand is CIO of Templeton. Templeton has had a rough phase in between, but the interesting thing which I noticed was that in that rough phase, he steered his fund to become the best performing fund in the country. In the most difficult times, under the most difficult circumstances, when investors want to take their money out of your fund, he steered that fund to become the best performing fund in the country, which is no small achievement. Anybody who is in the fund management business will understand how difficult it is to run a fund when the investors want to take your money away. So, right? So, these two are really kind to accept our invitation. We are leveraging our goodwill with them beyond what's reasonable, but I'm really glad that they have come forward to talk to us today, and we are also trying to record this for the benefit of those who could not attend. Hopefully we'll put it up on the YouTube of HCC if there is, so that it will be shared widely. I would definitely request you to share it with all your friends and share your perspectives and follow both of them, one for his investing and the other for his education. And I'm sure that today all of us have a lot to learn, and this learning journey which we begin today will continue, and you will see more learning in 2022. Thank you very much.
Good evening, everyone. It's my pleasure and a privilege to introduce such two eminent persons, as Shyam said, from our own city, to introduce them to you. One of them is an economist, the other fund manager. When you talk about economists, obviously when all your vegetables are now above 100 rupees per kilogram, you are worried about inflation. How inflation is going to impact you. And already Fed has announced that they are going to hike the rates in the year, 3 hikes. So how it is going to impact you? What better person than an economist, and an eminent economist at that, to talk about that. Our Prime Minister Narendra Modi does not miss an opportunity to give a Thirukural quote wherever possible. I thought, why not? From Tamil Nadu, I also may take this opportunity to quote a Thirukural. இருநோக்கு இவள் கண் உள்ளது, ஒரு நோக்கு நோய் நோக்கு மற்று Annoik Marund. It is about a Talaivan and Talaivi. Talaivi has one look which makes the person sick. The other look is the cure. When inflation is high, the markets fall drastically. But traditionally we keep saying, to beat inflation you have to invest in the stock markets only. So whether it is the disease or the cure, both are available only in the stock market. That is why you have your SENSEX 2022. The problem is also here, the cure is also here. You have to, there is nowhere else for you to go. Right. So, Mr. Arun G. Nagarajan, Chief Economist and Communications Manager. Mr. Arun G. Nagarajan works at Sundaram Mutual Fund as the Chief Economist and Communication Manager. With an initial 3 years in academics, Arjun's career in the equity market span over 10 years, of which he has spent over 8 years at Sundaram. Arjun was part of the Niti Ayog's discussion with economists on topical issues over the last few years. In January 2020, Arjun participated in a pre-budget roundtable consultation with the Honorable Prime Minister of India to discuss the policy measures for Budget 2021. Arjun holds a bachelor's degree in Commerce, MA in Economics and MPhil in Economics from the University of Madras. He also holds MSc in Economics and MSc Finance and Investment degrees from the University of Exeter, UK. He is also a General Council member of the Madras Chamber of Commerce and Industry. It's my pleasure to welcome you, sir. Let me proceed with the introduction of the other speaker also, a fund manager. So you have something for economists, you have something for the fund manager. Zomato, when they came out with the public issue, it was 69 to 72 was the price band. At 72, the valuation was 60,000 crore. They said it is overvalued. You say 60,000 crore of valuation is overvalued. It gets listed at 130, 140. It continues to stay there. Then what do you call that? So there are so many experts around in this market. So what to value, how to value, we do not know. But our markets are very buoyant. We have had so many successful IPOs. It's a booming IPO market now. With LIC IPO just around the corner, very interesting times are ahead. So to discuss about all that and enlighten us about how the markets are going to be in the days to come, we are very privileged to have with us Mr. Anand Radhakrishnan. Mr. Anand Radhakrishnan is MD and Chief Investment Officer Equity for Franklin Templeton Asset Management India Private Limited. Mr. Radhakrishnan is responsible for overseeing all the local equity funds. His responsibility includes mentoring all the portfolio managers, apart from continuing to be the portfolio manager for some of the key products. He manages Franklin India Flexi Cap Fund, Franklin India Tax Shield, Franklin India Technology Fund and Templeton India Value Fund. He is also the co-portfolio manager for Franklin India Focused Equity Fund, Franklin India Blue Chip Fund and Franklin Build India Fund. Mr. Radhakrishnan has been in the investment management industry since 1994. He started his career with Franklin Templeton in 2004. His past assignments include fund manager with Sundaram Mutual Fund for 8 years, deputy manager equity research with SBI Funds Management Limited. Mr. Radhakrishnan earned his postgraduate diploma in management from Indian Institute of Management, Ahmedabad in 1994. He earned his bachelor's of technology degree specializing in chemical engineering from Anna University, Chennai in 1990. He is a CFA charter holder. So with this, I am privileged to introduce our second speaker for the day.
Okay, I'll just start off. So thanks a lot, good evening. I hope everybody is fairly safe. Very, very tough times the last couple of years. So I think hopefully there shouldn't really be very tough times ahead, at least from a point of view of lifestyle and point of view of India going forward. So what I've tried to do here is I've tried to bring about a very broad, a very generalized and a very simplified sort of a structure I've tried to bring about here, just touching upon 3 or 4 topics, touching upon the US, touching upon China, touching upon inflation, touching upon what one should be aware of from a point of view of as an investor in the markets. That's broadly what I'm trying to deal with here. I'm trying my level best to keep all jargon away, so you won't find any jargon in this. I'll try to speak now. Tamil English konjam kalande na pesaren. The thing here, the one thing I want to sort of reiterate here is we're all, if we are an investor in the equity markets, we're always here in the longer run. We're always for the longer haul, not at all for the shorter. So it is always your risk appetite. So everybody asks, I've heard a lot of people say, hey, what stock should I invest in? What should I do? There is no answer to these questions. The only answer is you have to know what your appetite is for risk. And you have, more importantly, you should know how long you want to stay invested. So I'll give you an example that it took me a while to understand this. So I have a daughter who will turn 10 in next month and a son who will turn 4 next month. So for me, whatever investment I make in the equity markets, mutual funds, I don't want that money for the next 20 years. This is my time frame, this is my time horizon. And that's the only way in which I function. So I do not want a 1-year investment. I don't want a 2-year investment. I think this is something that it sounds very obvious, but time and again I've realized that's something that is very underappreciated. And because I don't want my money for the next 20 years, I would prefer. I'm 40, 41, so I would like to think I'm young, but my daughter says, no, Appa, you're very old. So from a risk appetite point of view, I think I don't necessarily I want a balance between large caps and small caps and mid caps, but I'd want to be a little bit more heavy on the mid and small because the risk is relatively higher, but your return is also better over the longer period of time. I think I wanted to say this is not my area, but nevertheless, I just thought I'd start off with this because this is something that I've noticed time and again. It keeps coming up, and I feel it's still very underappreciated as a concept. So from an economy point of view, pardon me, I'm sort of simplifying it a lot. Rombave na simplify pandre, but don't think it is too simple. This is exactly all you really need to know, because you are in the business where information is there every single second. With social media, with Twitter, every single second something or the other happens, every single fraction of a second, and you don't really know how the markets are going to react. Markets react to everything. So the job as an investor is to cut out the noise. That is the only thing you really need to do. So as long as your time horizon is long from an investor point of view, if you're a trader, it's a very different thing. Only if you're a trader, you must ever be bothered by all these news flows that you see on social media, this, that. Nothing really, if you're in the longer haul, nothing really matters. All you have to do is you have to identify your risk appetite, what time horizon you have to be invested in, and just it's like a longer version of test cricket if you can. So you might not have the excitement of one day, but nevertheless from a return point of view, all you're bothered about is the return. Not if you're in for the experience and you want the adrenaline pump and all that, then it's a completely different game. You can go into trading, or you can go into very, very extremely active sort of management. But if you look at research, it always tells you that the lesser you meddle with your portfolio, the more returns it gives you. This is something that time and again, all research sort of keeps telling you this time and again. I'll just start off with the first slide. Yeah, this is fine. I'll just start off with this. I've intentionally kept it blank. There's no legend. You don't know what the blue line is, what the red line is. I will I will bring this slide again in the end, and I will tell you what these are. These are two markets. It is amazing that every time I speak, even people in the financial community, they're very surprised when I show them this chart. So wherever I speak, whomever I speak to, I make it a point to bring this chart again and again and again, because like the first 2 points I said, I think this is also something that is extremely underappreciated. I'll come back to this. So let the suspense be there. I'll come back to this at the end. The next slide, please. Yeah, so see, this is, I'm talking purely from an economist point of view. So economists are criticized for everything. So we're all guilty for that. I completely agree. One thing I will tell you is, I don't know what's going to happen 10 minutes down the line. So anything can happen to me. I can get a heart attack. Anything is possible. So the only thing is that nobody knows what's going to happen tomorrow. But then the question is, okay, if I don't know what's going to happen tomorrow, then why does anybody hire me? The point here is that even though I don't know what's going to happen tomorrow, based on what has happened in the past. History always repeats in a very, very broad sense. And you have people who look at the very short-term cycle and say, no, this time is different. But if you look at the longer cycle, no time is different. It's pretty much the same. It always keeps repeating. So even though I don't know what's going to happen tomorrow, what I try to do, at least what economists try to do, is try and say, okay, what is the probability of this event? What is the likelihood of this happening? So what is the likelihood of me collapsing at this stage 5 minutes hence? It's to me, I would always have a bias. I'd say maybe there's a 2% probability that will happen, or if I want to be very optimistic, I might say a 0.1% probability that happening. So it is this framework. It is the framework that really matters. What is the framework that you're operating in? So I come back again, as an investor, the only thing that you always need to know is your time horizon and your risk appetite. This is the lens through which you have to see everything. So from an economist point of view, the exact number doesn't really matter. It's always the direction that really matters. In the first chart that we saw, it was always the direction that matters. There are two lines that are there on completely two different axes. So the returns are very different, but the direction is exactly the same. Next slide, please. Yeah, so I thought I'd address this straight away, because if you are an investor and if you read newspapers, pink papers, business papers, this is something that you will get to hear again and again and again and again and again. Let's say India is going to become a 5 trillion economy, a 10 trillion economy. These numbers don't really matter. See, it is, if I can use the word, it's a sales pitch, it's a marketing pitch that even the Honorable Prime Minister in a very honest moment, probably he said, these are all numbers that we just put out so that we give a sense to the audience as to, hey, this is where we're supposed to be heading towards. But in reality, these numbers really don't matter. This 5 trillion, 10 trillion numbers all depend on where the currency is going to be. So if the taper tantrum in 2013-14, that didn't really happen, India would have touched a $2 trillion dollar GDP size much earlier. That didn't really happen. It took 2-3 years, even longer. So these numbers don't really matter. It's again just a marketing pitch per se, but it's not that it's a white lie. It's just that it gives you a sense as to where we could possibly be. So if you're looking at it from a currency point of view, India is an emerging economy. We are a net importer. And it's very unlikely that we'll be structurally a net exporter anytime now, various reasons. But if you're looking at it from a historical point of view, somewhere between 2.6 to 3.2% is your annual average depreciation that you see. So if you had to sort of explain the recent depreciation that we've been seeing, it was coming from October onwards, because we've been running a trade deficit every single month of somewhere around 20 billion plus, when normally steady state our trade deficit is somewhere between 8 to 12 billion a month. So it's just a matter of time that it sort of happens, and this average depreciation is something that you'll always have to consider. Next slide, please. Yeah, okay. This in the entire scheme of things, possibly I shouldn't have had this slide here, because I don't think it's a very simplified slide. The point that I'm trying to make here is, from a US point of view, you will hear a lot about the Fed, a lot about this dot plot, this, that. All that they are trying to say is, see, the US the entire world went into a so-called recession because of the COVID pandemic. So it went into a recession not because of COVID per se, it's because of the fact that the economies had to lock down, the economies had to bring restrictions. As a result, economic activity was really, it started coming off, and you had the central banks, and you had governments starting printing money and trying to support the economy. So they started bringing growth in an artificial sense, but nevertheless, you saw a significant amount of growth coming through. Now, US economy has been growing very, very fast. Rumba faster it's been growing. So if you look at it from a theoretical point of view, central bank point of view, every central bank growth, rumba vegama growth, if it starts picking up, the tool always that central bankers use is we have to raise interest rates. So the logic is very simple. If growth is extremely high, you have to bring that growth down. And how do you bring growth down? By raising rates. So it is if you can use the word, it is a regressive tool or so, but nevertheless, if growth goes very, very fast, they fear that inflation is going to come extremely fast, and inflation romba vegama vandaduna, your standard of living gets impacted. And once your standard of living gets impacted, then everybody starts thinking that inflation is going to be here for longer. So the way they explain it is they say inflation expectations. So from next year onwards, I will think that inflation is going to be even higher, and as a result, companies will start pricing their products higher, and it's a never-ending cycle. And the cycle break பண்றதுக்கு தான் central banks they start cutting increasing rates. So when they increase rates, activity automatically starts coming down. When activity starts coming down, then your inflation, your prices also start moderating. So central banks want growth. They are not anti-growth, but they want growth in a very gradual fashion. They don't want growth in a very, very sharp way, because sharp growth causes sharp inflation. Sharp inflation causes growth to break on its own. Over a period of time, it's not sustainable. So central banks keep coming in. So the relevance of the Fed policy, whenever you read about the Federal Reserve in the papers, when you hear the words hawkish, when you hear all these words, the only thing that they are trying to tell you is US economy is going very, very strong. And inflation is really high. The central bank in the US wants to control inflation, and the only way they can control inflation is to increase interest rates. So when they increase interest rates, slowly it will start moderating, and it is more sustainable. It won't lead into some sort of a collapse. So that's the only relevance from a Federal Reserve. So the immediate relevance that Indian markets look at is, the last time around it happened, markets were in a panic mode, because there are two things here. 2013, when the taper happened, emerging markets were not in great shape. This is something that you would have heard time and again. Last Varshama, every paper would have been talking about this again and again and again. So our current account deficit, our fiscal deficit, all of that was, like in other emerging economies, was very high. This time around, it's much better. Our forex reserves are much better. The RBI has a lot of forex reserves in there. So the probability of a negative event is very, very low this time around. So from a point of view of the reason why the markets keep talking about the Fed is they always say, okay, Federal Reserve, they start cutting the balance sheet size, they start raising interest rates, markets will fall. So it is not a one-to-one relation, because the last time it happened, the context was very different, the background was very different. This time definitely is very different. So it is not a one-to-one. Then why do markets react? We'll come to that in the last slide. So if you're looking at it from a US point of view, US la the next 2022 US growth drivers irka. If you ask that question, the answer is 2, yes. So there are drivers in the US to grow. The first driver is the fact that you've had a lot of excess savings in the US. So because of lockdowns, people were not able to spend as much as they would have normally spent in certain areas, and that has really caused a pile up of excess savings in the US. So that is one driver, that a lot of estimates talking about how you have enough money in the US to spend for at least the next 1 to 1.5 years. Second is that because of this demand pickup in the US, inventories are completely run down. So inventory and the restocking of inventory in itself is seen as a driver of growth for the next 1 year. So US growth unlikely to come off or slow down in any significant way into 2022. Now, idellame assuming that there is no Omicron, there is no Omicron related significant curbs, etc. Next slide, please. Okay, so there are 3 ballparks, the 3 areas you need to really think of when you look at growth into 2022 from a global point of view. One is US, second is Eurozone, third is China. Eurozone is not as much, but nevertheless is something that is important. So as we stand today, we are hearing a lot of narratives around Omicron, around COVID. So I thought I'll just, like an onion, there are 3 layers to it. I'll just peel one after the other. So the first layer is COVID. Now even Omicron narrative start பண்ணது வந்து November 19 the first strain was noticed. And from November onwards, the markets have been on panic mode. At least I'm saying the narrative has been on panic mode because they never could understand whether this was worse than Delta variant or not worse than Delta variant. So it's reasonably settled now that it is not worse than Delta variant. The transmissibility, that is on the paravara thanma, it is 70 times more than Delta, but hospitalization curves it is still lower than Delta variant, and death rate it is much lower than Delta variant and all the other variants as well. So it is not as harmful so far, that studies are saying, on the human body as much as the Delta variant. Now that's so that the Omicron narrative has slowly died down. So even before Omicron started, if you notice, US, Eurozone, all countries, a number of countries were actually seeing a third wave or a fourth wave according to their waves. They were actually seeing a pickup on the back of Delta. So Delta continues to remain the dominant variant. Around 37% of the incremental cases are on account of Omicron. The rest of it is Delta. So now why are countries bothered? The thing is that from a political standpoint, politics always works on perception. No political dispensation in any country wants to be seen not doing something. So that pressure is always there. That is on the one hand. The other hand, a number of countries, they've experienced 2 years of the informal segment, or in general, they've actually experienced a lot of disruption in their incomes. So on the other hand, you have a lot of pressure from this group saying we don't want lockdown. So you've actually been hearing a lot of countries in Eurozone, in Europe, they're resisting and they're striking, they're saying we don't want lockdowns, etc. So this time around, it looks very unlikely that there will be lockdowns. But last 3-4 weeks away, we've actually heard a lot of restrictions. So there is incentivization saying if you vaccinate, you can come inside this. If you vaccinate, you can get into the restaurant. So the likelihood of lockdowns are very unlikely this time around. The other positive is that on average, world vaccination rate is north of 80%. India, if you see, I think we're at 90% or so of vaccination single dose for the adult population, 90% plus. And adult population, I think we are 56-57% plus of double vaccinations for the adult population. One disadvantage is that it is still stuck with the adult segment. On the under 18 has still not really started. But from a vaccination point of view, if you look at let's say UK, other countries, the infections curve is very, very high. But if you look at the mortality curve, it's very, very muted because of the fact that the vaccinations has really helped. So coming to the entire thing that I started off with, so the narrative of COVID this time around, the probability of very hard lockdowns are less, and because they are less, the impact on growth is likely to be lesser, is what it looks like at this point in time. US is doing very well. US growth is fairly strong. There seems very unlikely possibility of any sort of hard lockdown. So US growth is likely to sort of middle around and actually even pick up into 2022. China has been very significantly affected by this. And there are two reasons. One, you had energy crisis, you had a lot of over-tightening in China on the policy issues. So a lot of reasons have really pulled down China growth. One very significant reason that slowly analysts are sort of understanding now is China has this policy called zero COVID, where until there is zero COVID, they will continue to impose restrictions and lockdowns, etc. This is something that Singapore in around June, July this year sort of realized that they said, see, we can't really keep doing this. We can't keep locking down because the virus is actually here to stay. We have to help build herd immunity, and that is the only way out. So they came away from the zero COVID policy. Australia did that very recently as well. China is still holding on to a zero COVID policy. And a lot of researchers and analysts keep saying that, see, as long as zero COVID policy is there in China, these COVID waves will keep coming in. So you have very frequent COVID waves in China because that herd immunity is still not really picked up. This is what research is saying. So until March or so, when all the big policy makers in China meet next year, it doesn't look like China is going to move away from this zero COVID policy. So, which then means that China growth might sort of not really drop significantly, but will be hereabouts. What can change that is over the last 1.5 weeks, there is a lot of narrative. So China, when they cut triple R rates, which means they're infusing a lot of money into the economy. They cut their policy rates. There is a lot of narrative in the over tightening property sector. They sort of easing the tightening in the property sector. Policy side, there's a lot of easing that is taking place. And as a result of that, they have realized that into 2022, they want to focus more on growth. They want to focus more on credit and help the property sector incrementally. So, though on the one side you have zero COVID policy of China, the other side China is expected to really spend a lot. So, fiscal stimulus vara chance irukku from a China point of view. So, if you look at US and if you look at China, US incrementally there is some growth that you will see, and China, if the COVID is not a stumbling block, the stimulus that will come from China will also incrementally see growth into 2022. So broadly, from a demand point of view, we seem to be fairly well placed from incremental US growth, incremental China growth. The third variable to look at here is the supply chain bottlenecks of the entire. So if you look at ports in China, because of the zero COVID policy, there are very frequent disruption in port activity. And if you look at semiconductor chips, they use something called lead time in the sense the time between ordering a chip and delivering the chip. Normally it is around 8 to 12 weeks. It is currently at around 23 weeks. It is still not really normalized. So into the first 3 months of 2022, I think mostly by Jan end, I think one should get a sense if this supply chain constraints, especially on the chip side and on the port side, if they are easing. So freight rates have started easing to a certain bit. NLA indicators that you look at freight rates and container activity, it has eased. That bottleneck has come off, but there's a lot more to come off. So it looks like by Jan end or mid-Feb, we should get a better sense of that. So if that does get better, then I think it will give this US and China growth, it will give more impetus, or it will allow this growth to really manifest itself. Next one, please. Okay, so one thing I thought I have to talk about here is inflation. So when you talk about India inflation, there are two things here. People talk about WPI, people talk about CPI. Now, they are completely different creatures. So if you look at the WPI nearly 50% of WPI is imported items. 60-65% of WPI are all manufactured goods. But if you look at CPI around 46% is just food. Just food, there's nothing else. So if crude prices go up, the CPI won't really get impacted. If excise duty is cut or increased, CPI gets impacted. But if crude prices go up, WPI is significantly impacted. So if I can loosely say, WPI is the inflation that India experiences. CPI is the inflation that the average Indian experiences. They're very different things. So this is one very big difference that you should remember. Second thing is, whenever you hear WPI going up, inflation going up, it is very you have to tie it up with companies. So the right hand side chart, what I've done is within the WPI you have input items and you have output items. So if you look at inflation in the input items and inflation in the output items, you can actually see that the inflation and the input items have gone up quite significantly. The way you read this is, if you are familiar with the term gross margins of companies, the margins of companies start getting contracted because their input costs are going up. Output prices have not really gone up as much. So if you look at the WPI, invariably most of the movement in the WPI increasing is because input costs are going up. So it is a fair assumption to make that whenever WPI goes up, you know that company or manufacturing companies' costs are actually going to go up, and it will hit or crunch their profits to an extent. This is the very simplistic way to actually look at it, and this is something that you can see. If you plot them together, you will actually see that as well. Now if you look at CPI, this is very important because if you look at it from an RBI point of view, RBI won't talk about WTI, WPI. When Subbara was the Dr. Subbara was the RBI governor, you had the WPI as the policy rate. It's no longer the policy rate, it's CPI that is the policy rate. Now CPI is actually very interesting. If you plot CPI and rural wage growth in India in general, you will actually see they've historically moved directionally in line. There's been no difference. This time around, if you see the last couple of years, we don't know if it is COVID, we don't know if it is not COVID, but that relationship appears to have broken to a certain extent. But one thing you can say for sure is that rural wage growth has marginally picked up, but it is not significantly picking up. So the probability of CPI going very high seems very low, and that's something that you can also hear in RBI commentary. So the way the RBI is looking at things, so this time around, for whatever reasons, political or otherwise, the political dispensation, the central government and the central bank are on the same page, and I think that's a very good thing for growth, because the RBI's narrative is very clear. They're saying until growth comes, we will use every opportunity to keep rates low. This is what they are actually saying in very simple terms. And the VRRR, terms are there, but in very simple terms, this is what the RBI is saying. The RBI is saying, see, growth is not very strong. Growth is there, but growth is still picking up. We don't want this growth to really get impacted. So as long as possible, as much as we can, we will keep rates low for as long as possible. That's basically what the RBI is saying. And the RBI looks at the CPI. So next slide. I think I'll just speed it up a little. Yeah, so there are three things that are very, very important you have to know. I'm again simplifying here. So when you use the word inflation, there is no one inflation in this world. So if this room has 100 people, there are 100 inflation rates here. So if I'm a vegetarian, I have one inflation. If I'm a non-vegetarian, I have another inflation. If I'm a vegan, I have another inflation. So inflation is a very simplistic term. We've really simplified it. So for practical purposes, the RBI has an inflation called CPI, and they use it for practical purposes, because at some point in time you have to generalize, and it gives you a very good signal as to what is happening in the economy. But in real life, there is no one inflation, because everybody's consumption basket is different. So there is no one inflation. That is something that has to really set in. So that's one very important component that you really have to remember whenever you're reading anything on related to markets or the economy. The second bit, GDP is a forecast. Nobody knows what India's GDP is. Nobody knows. India imports more than what it exports. So the currency is not really bothered whether you pay for that import with borrowed money, or so borrowed money is here, let's say FII money. If you pay for that import with own money, which is, let's say, FDI. The currency doesn't really care. As long as money is there for whatever you are spending, the currency is not really impacted. But when you start seeing a mismatch here, when your import is very strong, you're actually consuming more than what you can actually pay for, then the currency starts depreciating. So that's what I talked about how India's trade deficit is 20 billion plus every month. That's not something that is sustainable. For our size, economy size, we can manage, and our flows, we normally have been historically managing around 10 to 15 billion every month. 20 billion is out of our reach. So it is just a matter of time when the depreciation will happen. So let's say 3 weeks ago, before this depreciation happened, India's YTD, we saw an appreciation of 0.6%. So you know for a fact, when you see India has appreciated in 11 months in the year, you know for a fact that depreciation is just an eventuality. It's just a question of when will it happen. So when you're looking at it from an investing point of view or a markets point of view, it is, I'm not trying to oversimplify it. It is this simple. This is all that you really need to really know. All the jargon, all those numbers, charts, all that really doesn't matter. It is, at the end of the day, it is all, it just boils down to this. Do you have the money to pay for what you're consuming? The next one, please. Yeah, so I'll end with this one. The suspense is broken. Next slide. So basically what these are, one is your SENSEX. Every month your year-on-year SENSEX returns, and the other one is US S&P 500 year-on-year returns. So the left-hand side chart is from 1999 to 2009. You can see that Indian markets returns have directionally moved exactly in line with the US markets. And the right-hand side, you can see the relationship is even better. So there are periods where there are divergence, but the divergence doesn't really stay for more than 1.5 to 2 months. At the end of the day, they actually start coming back. So the third chart is basically that circled area. I've just magnified that and I put it there. So in a way, I should not be saying this, but then rather an economist shouldn't be saying this. If you actually look at this is only the index. So your mid cap, small cap, all that is a different ball game. I'm just looking at just the large cap, just the index. I think it is fair to say that the domestic CPI, IIP, GDP, all these numbers that we talk about, if you look at it from a market point of view, they won't really match for very different reasons, and this is one very clear reason, or rather a variable that completely explains why your market moves the way it moves. So all these headlines you see in newspapers, it is very important to know. But at the end of the day, if you want to see the directionally where our Indian markets are moving and why they are moving, I think this is a very good explanatory chart. I think I'll end there. I think I've taken a fair bit of time. I think I'll end there. Thank you. Thanks a lot for the opportunity.
Thanks. Good evening, everyone. I'll start with a small story. Last year, around April, May, a friend of mine who generally is very heavily invested in stock market, I wanted to check with him how he is doing. So I called him and I asked him, like, markets are so down. How are you doing? He says, no, I sleep like baby. I said, is it? I was very surprised. What do you mean you sleep like baby? And he said, yeah, every 2 hours I wake up and cry. I look at my portfolio and cry because I'm sitting on such huge losses. And of course, I was talking to him last month and I was again asking him. He says, I'm still sleeping like a baby, but this time undisturbed. He's sitting on a lot of money. So within 1.5 years, things have changed for better. Now the idea here is to look at how is 22 going to be. I think there are 3 big issues we need to get a clear understanding. One is this entire liquidity. People say that this liquidity is what is driving the market. So we should get a fix on what is this liquidity, where it is coming from, whether it is going to just simply evaporate. So I will focus 5 minutes on that. And next is there anything really changing in India, or is just mimicking US like what Arjun was telling? And are we looking at better days than what we were in the past? And third is, of course, is it extremely risky in terms of valuation? Next slide. So clearly, yeah, we have come off that big drop and is now pulling back. And not only India, I think globally, most economies are today in better growth than what they were earlier. So in some way, COVID has shaken the world up and have put some pressure on the policy makers to drive growth. Today, even India is talking more growth now versus pre-COVID. If you remember, December 2019, we had one of the worst GDP growth quarters. And BJP used to make fun of Congress for delivering lowest GDP growth. And they themselves had the worst GDP growth in the last, quarterly GDP growth in the last decade. But somehow I think COVID has come and shaken up that complacency and have pushed the lawmakers and the policy makers to focus on protecting the economy and pushing them towards growth. Next slide, please. So this is now the expected growth for the next year. I think we are going to grow at around between 8 to 9%, which is pretty high versus what it was in 2018 and 19. So on a year-on-year basis, we should be pretty okay. Next quarterly print has come and it's around 8.5 or 8.9%. This was 20.1. I think the next quarter is around 8.5 or so. Next slide, please. So growth is okay. And growth will continue to be reasonably okay for US, for India. That is the one simple point. The second point is this so-called inflation interest rate, which Arjun again talked about. Here I have a slightly different view. there was a time where India was always running very high inflation and US was having very low inflation. This was for a decade. So Indian inflation used to be, I think for first 5 years or 4 years of the decade, it was over 10%. And then next few years it was at 6%. And then again it came down below around 4% and thereafter. Whereas the US was constantly at around between 1 to 1.5% kind of numbers. The inflation differentials between India and US are very high. And because of that, we had successive RBI governors coming and maintaining a very tight policy, that is very high interest rates. So whether Raghuram Rajan or Urjit Patel, all of them are called hawkish hawkish central bankers. Luckily, we now have Shakti Kanta, who is a lot more pragmatic and a lot more looking at data rather than trying to project data too much. So they are looking at it as it is and taking policy decisions. And here, this is the differential between, I don't know whether it is clearly visible, the difference between India inflation and US inflation. It used to be, the green means it is positive. The difference is India is high. Of late, India has gone to negative. Now today is India 2%, CPI is 2% or some 1.9% less than US. Whereas last 10-year average is 4%. That this mean number. 4%. So we have 4% higher inflation over 10 years, and that's the reason why rupee always used to depreciate against dollars. Because there is a theory is that if you run a very high inflation economy, the currency will take a knock. It gets adjusted. Now the question is, are we going to be having the same inflation differentials over the next few years or not? My view is that we are not going to have this kind of differential that we had in the last 10 years. Then what should we do? Then should we continue to have very high interest rates, or should we have lower, next slide please, should have lower interest rates? Unfortunately, while inflation has dropped, next slide, inflation has dropped, interest rates have not dropped in India. If you look at Indian interest rates today, the 10-year is still at 6.5 and US 10-year is at, I don't know what's the latest number, it's probably 1.5, 1.35 or so. So the differential is still 5% between Indian 10-year and US 10-year, whereas the inflation is only negative 1%. So while our short rates are very low, our long rates have not fallen down, longer tenure rates. So even for you people borrowing, some of you borrowing money, the interest rates have not come down as much. Maybe for a mortgage housing it has come down, but if you are a SME, if you run a small business, medium business, bank lending rates have not come down very steeply for the borrowers. I still think that there is a good scope for Indian interest rates to be moderate, as long as inflation remains moderate. Now, why would inflation remain moderate in India? Is the big driver of inflation is food prices, and food prices have now reached almost parity with global food prices. It is not as if in India food is cheap. The agricultural food product prices, whether it is wheat, rice, sugar, soya bean, etc., all of them have reached international prices. Now, where will you hike these prices further from? You cannot hike. So, if food inflation doesn't go, next is energy inflation, oil. Will oil prices go up? Already people are shifting to electric cars, and people are projecting by 2025 or 2028, most of the two-wheelers incrementally getting sold in India is going to be electric, and they are not running on oil, petrol, diesel, they are going to run on electricity, and that electricity will be made from either coal or it's from solar or wind. So clearly there is a globally pressure on oil consumption. So oil will not go up at all. So if oil doesn't go up, energy doesn't go up. If energy doesn't go up, commodities don't go up. If commodities don't go up, then because all commodities are made out of energy, steel, aluminum, copper, zinc. So if they don't go up, those prices don't go up. So second thing is also gone. Then many of the other things that we use, rent, which is like housing price, house prices, etc. Though the affordability is high, there is still a lot of supply. Supply of homes are there, and I think many markets we still think that the prices won't go up significantly. Demand will go up, but prices won't go up. So very multiple components of inflation in India will, Services is one area where inflation in India will keep going up, but that is not a, as of now, big component. I mean, education is one of the biggest component which keeps on going up year after year. All our school fees which we pay keep going up. So that is the second point, that is interest rate. Therefore, while US may hike interest rates and Indian interest rates may go up in the short part of the short end of the curve, the long end of the curve, interest rates will go up. Next slide, please. So I feel that we are here. The structurally low interest rates are going to be here for a longer period of time. Especially, I think the policy makers are also, though there is a lot of talk about inflation can come into India, blah, blah, etc. I think they, in their mind, they want to keep low interest rates. Next slide. Second, I think another point is India very vulnerable today versus what it was in 2011-12? And when oil prices touched 100, rupee took a knock between 45 to 65 or 70 or something like that. Is it again going to happen? One is, anyway, oil price is not going to go like I explained. Even if it goes, today India's external account is a lot more resilient or a lot more stronger than what it was in 10 years back. Yeah, so I think there was an analysis done by one of the analysts which says, earlier our tolerant peak oil was $70 to a barrel. Now it is $100. That means till oil touches 100, rupee won't come under significant pressure. Plus, in between software exports, which was $70 billion then, has gone up to $100 billion. FDI remittances, FDI investments have gone up manifold times. Foreign currency reserves is at all-time high. So I think today we are a lot more. We were at that time part of the fragile 5 or fragile 3? Fragile 5. We were part of fragile 5 economy at that time. Today we are not. Today Turkey is in a fragile situation. Some other Latin American countries in fragile situation, but not India. The reason is today our balance sheet of the country has become better, and even P&L, trade account, has become better. Next slide. And this is another most important thing is, I think a lot of effort is being done to revive manufacturing in the country, and therefore you are seeing a lot of people setting up factories across length and breadth of India. Part of it is because there is a China plus one strategy. So we are seeing many companies which are only using China as a one singular sourcing base are today looking at countries like India, Vietnam, Thailand, even Bangladesh, where they are setting up alternate factories, and therefore you are seeing a lot of FDI come in the form of manufacturing. The PLI schemes for various sector, production linked incentive schemes the government has given, is again benefiting. So what we are going to see is a lot more factories like Foxconn and things like that getting set up in India, and India will import less of electronic items. Of course, they'll import some components and even more components, but they are not going to import finished electronic products, which is good, which means our import bill will reduce and export may even pick up. Next slide, please. So these are all big reasons why I think we are not going back to what we were pre-COVID. We are going to a different situation, a better situation in terms of economic activity, and that is already being visible in the market. So some of the market is run by liquidity, that is very clearly there, but some part of the market is run because of real fundamental change that is there in the corporate landscape. Final one point why we still think that the best is yet to come is on the credit. Now the best way to boost the economic growth is to pump credit into the system, that is make people borrow. And luckily, India is one of the economies in the world where household debt as a percentage of total GDP is low. Whether you compare it with China or US or many parts of Europe, many of the other emerging markets, India is still, an average household has not borrowed money. They are okay. They have in fact today very high amount of money in their savings account. So we think that the banks can now start to lend very aggressively, and that will lead to a very good aggregate demand cycle coming up, and people will start buying things, cars, houses, etc. Till now, because we are still not fully out of COVID wave, everyone is playing it safe. But if you run a survey and ask people, what are you going to do if tomorrow I declare that there is not going to be any more COVID, then what are you going to do? And you see the optimism will be brilliant. And that is because now they have money power, firepower is there. For some reason they have not spent that money, it is there in the banking account. On top of it, banks are going to give some credit to you at a very cheap rate. So that both combined together will lead to a big boom. I think calendar 22 may be a beginning of it, if all things align. And of course, it is in the interest of the government to do it. The reason is very simple. There is a UP election coming next year, and then 2024, next another election is coming. If you do everything in 2023, it won't show up in the economy. By the time it shows up, the elections will be over, you may lose the election also. So if at all they want to do something big bang, it has got to happen in next 3 to 6 months, whether it is tax cuts for individuals, whether it is incentives for housing, it is now or from now to 6 months. After that, if you do, it's too late and you may lose elections also. So I think somewhere the policymakers would know it, and I think already the FM is started the consultation process for the budget, and you would see some of these things kind of play very well over the next 3 to 6 months. Next slide. You can skip this, you can go to the next one. Of course, this chart is the banks' NPAs, which are now come down. So earlier banks were very terrified of lending, and there was a kind of a credit aversion that was there. But today, I think slowly many of the private sector banks are showing the way, and soon, so better capitalized public sector banks will start to lend, and that would lead to big credit growth. Current credit growth is in low single digits, and whereas we can easily grow at 15% credit growth. Next slide, please. I touched upon this, PLI. I think the bottom slide is slightly vague, maybe, I don't know. Manufacturing as a percentage of the economy. It used to be 20% in the 1990, it has fallen down to 15%. I think what the stated objective is by fiscal 2030, it has to go back to that 20. So there is some sort of a revival of manufacturing sector will happen, partly through import substitution, Atmanirbhar, however much we can make fun of it, it will work. And partly because, you know, the global world is trying to use India as a source, like I explained. Combination of both will lead to better performance of the manufacturing sector. Next slide, please. So moving on to corporates, how this is going to change the way companies are operating. Corporate profit as a percentage of GDP rose from 2% to 7% in between 2002 to 2008-9, and then slowly it started coming. I think we are now at the beginning of the next wave. We may not go all the way up to 7%, but it is very likely we will go up to 3, 4, 5% as a percentage of GDP, because corporates are one of the biggest value adders of GDP, and that profit is an indication of their value addition. And I think this is, when there are various reasons why this thing fell. I don't want to go into it, but many of these reasons are now aligning for better. Because it is aligning for better, our prediction is next 5, 6, 7 years, corporate profits as a percentage of GDP will turn to better times. Next slide. And this is going to reflect in the listed companies' earnings growth as well. This is EPS of index. During this period, fiscal 9 to 20, the EPS growth is only 6%. Of course, COVID came and kind of blunted the growth a bit. Otherwise, it would have been probably 8, 9%. But now I think we will probably look at intermediate period of 20% growth. Most companies are looking today lean and mean. Many of them who have borrowed money excessively have used the liquidity to repay the money, raise equity, IPOs, rights issue, QIPs, all of them have been done to deleverage. So deleveraging of corporate balance sheets have happened. Many companies have become healthy, many banks have become healthy, and most of them have cut costs, and therefore you will look at, even with smallest demand uptick, a significant improvement in profitability. Next slide. So this is the same thing in a different index, MSCI India. Again, we are looking at a high growth. Next slide, please. This time, this is one important point. There was a time in between 2016 to 19 where only few companies were showing growth in the entire economy. It can be, Reliance or TCS or HDFC Group. So what happened? All the market movement was only concentrated on those 20 stocks. If you don't own the 20 stocks, you will end up looking very, very poor. Your portfolio returns will be very bad. And rest of the companies were struggling or not making enough money. I think in the last 1.5 to 2 years, more and more companies have started participating on the earning revival. Now it is metal companies are also making money. Telecom companies which are making losses are making money, and healthcare companies are now making money. New kind of healthcare companies are coming and getting listed in the market. I think recent one was one of the pharmaceutical chain from South India, MedPlus pharmacy chain. We will see more of these innovative business models. Good disruptive businesses come and set up. And this is going to be very interesting period for, we have record number of unicorns, all these stories you guys know, I don't want to go into it. But the key point I want to do is, the choice of investment today is lot bigger and wider than what it was 3-4 years back. Today, if you don't own HDFC Bank or Reliance, you don't have to feel bad about it. There are many other stocks available which are fresh and off the growth blocks. And if you can invest in them and hold them for 10 years, 5 years, 10 years, will make a lot of money. Next slide, please. Okay, this is very technical. I will just leave it because there was a time where the strong became bigger. That is, in every sector, if you look at the top 5-10 companies, kept on acquiring lots of market share, whether it is banks, automobiles, cement companies. Just explaining bank so that you will understand. At this point of time, top 6 banks took 37% market share in terms of loans. It became 49 in fiscal 2010, 17, 20, now it is 49, which means the big banks kept on becoming bigger. Similar is the story with cement companies. Big cement companies kept on becoming bigger. And the font is not clear, so I'm just trying to explain that. But I think that's why, some of the big companies' valuation kept going up. The PE, price to book, all of them became very high. I think this will change because now the smaller companies are also getting benefit of this liquidity, low interest rates. So they are also beginning to now grow. So you will see next 5 years, some of them will cede market share. Maybe a bank will cede market share to a fintech company. Maybe a cement company will lose market share to a smaller regional cement company or ready-mix company. You should be open to the idea that even smaller companies will do better. There was a time small companies post demonetization were struggling, but there is going to be a time where they are going to do better. The structural loss of market share by the second line of companies to the first line of companies may or is going to probably change, is one of my prognosis. Next slide, please. Final, this is the toughest part. Normally, I don't want to spend too much time on this, but valuations. So, is market rightly valued? Is it, if you invest now, are you going to make money? Those are the typical questions we all have. Even I keep struggling with this. So, yeah, clearly the liquidity has taken the market up. But the first chart, there is a steep fall in the PE of the market. It is not because the market has fallen. It is because the earnings have started coming. The PE went up partly because earnings fell and then partly because markets went up. Now PE is coming down not because market is coming down, but the earnings are catching up. I think if you don't do anything, it will slowly come down. Not because market will come down. The earnings will soon to catch up. I think that is a simple point. While on a PE basis, it may look slightly above average, on a price to book or other multiple, price to sales, etc. There was a time Maruti used to trade at 4 times price to sales. Today it is trading at 1.5 times or less than 1.5 times. Maruti's car manufacturer. So you may say market is at a new high, but there are many companies which are still at a new low in terms of valuations. So we can look at a lot of companies. So if you still don't like the market, you can go and invest in a dividend yield fund or a value fund. There are enough choices available in the market to invest and make money. Next slide. Second is India overvalued versus the other markets? Typically we compare ourselves with other emerging markets, especially China. But the problem with comparing ourselves with China is China has recently cracked down on many corporates. All of you might have known, government has gone and clamped down on some of the big tech companies there, and many of their valuations have halved. Alibaba used to be some 500 Hong Kong dollar, now it has become 250 Hong Kong dollar. Similarly, Tencent and many of the other tech companies there have collapsed. Now, because of that, the PE of China has become cheap. Now, will you go and invest in that just because the PE has become cheap? You will not. The reason is, tomorrow government can come and shut down some other business, because there the government is all powerful. At least in India, till now, the government has not done anything like that. They have not meddled with the corporate world. The only thing they are trying to do is sell the companies they own, not try to take the companies which they don't own. So in that sense, I think investors are beginning to realize that India is relatively a safer market versus China, and we are seeing shifting of money from China. So for now, China will look cheap, India will look a bit expensive, but you will have to bear with that issue. Post demonetization, we saw all the mid and small caps go through super high valuation, a lot of money was made and a lot of money was lost as well. I think we are having something similar problem here now, where a lot of mid cap, small cap, which don't have clear stories. Of course, if the story is good, you can still pay them 20, 25 PE or 35 PE, some guy higher valuation. But today, a lot of companies are trading at 70 times, 80 times, 100 times. Word of caution is avoid them. Please don't go near. However strong the story can be, because sometimes story follows the share price, not the share price follows the story. As the share price keeps going up, the story keeps getting invented. So we have to be very careful and say that, what is looking reasonably valued, I am going to be there. What is not looking reasonably valued, I am going to stay away from that. So I'll just stop there. Thank you so much, and then maybe summarize, 2022 is probably going to be a reasonable year. It's not going to be very fearful.